Welcome. My name is Evan Unzelman. I am the CEO of CRT Experts, and thank you for joining us for a discussion on using charitable remainder trusts as stretch IRA substitutes. We are recording the webinar for all of our live participants. We'll get an email out tomorrow that will have a link where you can go watch a replay of the full webinar or whatever parts might pique your interest here today. Just at the outset, a quick overview of what we'll talk about. Of course, we're all aware that the Secure Act effectively ended the stretch IRA, reduced that stretch to 10 years. Today, we're going to talk about how to replace that stretch with a charitable remainder trust. We'll talk about the basics, how it works, when and how it's implemented, who's a fit, who's not a fit. But we'll also go beyond the basics. Once we've decided, the client has decided they'd like to use a CRT to replace the stretch, as we'll see today, all CRTs are not created equal. We'll talk about how to best design that CRT so that it's maximizing the amount of wealth that's transferred to heirs and accomplishing what the IRA owner has or intends it to accomplish. We'll look at a comparison of a family who uses a CRT as a stretch replacement, family who doesn't, and we'll use that comparison to look at some of these design features with CRTs that, in our experience, are underutilized. Hopefully, most of you are familiar with CRT Experts. Before we jump in, I'll just give you a high level on us here. As the name suggests, CRTs are all we do. For several of us here at CRT Experts, we have spent our entire professional lives working with charitable remainder trusts. For me personally, my work with CRTs began in the early 2000s when I was on a team that developed a secondary market for income interest in CRTs and a related buyer pool. It's a topic for another day, another webinar, but the income interest in a CRT is a capital asset. And like other capital assets, it can be bought and sold or used to create a new CRT with different terms, what's called a CRT rollover. This is always been where I and most of the team here have worked most within the CRT space, what we call CRT secondary planning, reviewing typically older CRTs that are deep into their life cycles, and initially just making sure that the income beneficiaries are aware of the options and flexibility that they have, and then where appropriate, helping them sell or roll over their income interest. The starting point is always a review of the CRT. So what that's meant is we've looked at a lot of CRTs here. We've reviewed a lot of CRTs over the years. At last count, we had reviewed the team here a little over 10,000 over the last almost 25 years now. And that experience has really shaped the way we approach our work with CRTs today. We work a lot at the very front end of the CRT life cycle, helping design CRTs and helping advisors implement charitable remainder trusts. We also administer CRTs, particularly more complex structures, NIM-CRTs, flip-CRTs, other income deferral CRTs, CRTs with multi-tier income beneficiary structures, CRTs that hold closely held business interests or other illiquid assets, and the like. So our work really extends from the very front end of the CRT life cycle with CRT design. What we'll be talking about here today is even before that CRT is in place. And our work extends all the way through the end of the life cycle, helping clients with mature CRTs exit those trusts in the most appropriate manner, and everything in between. So we run the gamut here at CRT Experts. For advisors, it's important to note that we do not manage or custody assets, and we do not provide tax, legal, or investment advice. That is by design. We were built to work through advisors, not around them. So unless you're in the CRT business, we should be a non-competitive resource that you can bring in when a CRT planning issue comes up. And that's our goal. Our goal is to be the first call for tax, financial, and legal advisors whenever CRT questions or issues arise. We're located here in Leesburg, Virginia, about 45 miles outside of Washington in Northern Virginia. So the problem, of course, what we're here today to talk about is this problem that the Secure Act effectively ended the stretch IRAs. Instead of beneficiaries being able to withdraw income for their remaining lifetimes, they must withdraw it over 10 years. And of course, those distributions are going to be taxed at the highest applicable rates. Whatever you want to call it, you want to call it a tax disaster. It's effectively the Secure Act is effectively a large tax on the IRA after the death of the IRA owner. But however you want to describe it, for many clients, particularly those who had planned on their IRA distributing over the lifetimes of their heirs, this creates a problem. Fortunately, though, with a charitable remainder trust, we have a pretty natural solution. When we think about an IRA, really at the core of it is tax efficiency. That's tax efficiency is what's driving the value of the IRA. We are investing pre-tax dollars in a tax-free account. And even though the Secure Act ended the stretch so that the IRA can't stretch beyond 10 years anymore, we can replace it with a charitable remainder trust. The CRT is an exempt trust. It's tax-free, just like the IRA. So on the IRA owner's death, the full value of the IRA can go into the CRT with no income tax. Like the IRA, the CRT is then able to grow those assets tax-free. So the investment advisor has the benefit of no tax drag on the investments moving forward while they're in the exempt CRT. We'll look later at a design twist where we can design that CRT to put an upfront deferral period on it. So not only do we have that tax-free growth inside the trust, we're also not making distributions, and we'll look at the impact that has on the income that's paid down the line to the children and grandchildren. So like an IRA, where taxation comes into the picture is when it comes to the distributions from the CRT. The distributions from the CRT are taxable. Unlike an IRA, though, the distributions from a CRT are eventually, the CRT is eventually able to distribute capital gain. I say eventually because it will take quite some time to get to that point. So if you're familiar with the way that income from a CRT is taxed, it's taxed on a worst in, first out basis. There's a four-tier accounting structure. Ordinary income is at the top, then capital gain, then exempt, then corpus. And the way that it works is any ordinary income that trust has and is undistributed, that has to be distributed first for purposes of taxation on those distributions. So in a traditional CRT scenario, so I'll mention this throughout, when you hear me refer to a traditional CRT scenario, what I'm referring to is when a client, what we typically see with CRT creations, where a client owns appreciated property, they want to defer the capital gain, create a lifetime income stream, so they contribute that property to the CRT. That property is typically a capital asset, appreciated real estate, closely held stock, publicly traded stock. So when the trust sells the asset, it's filling up that capital gain tier. This is different. With an IRA, if we've got $1 million IRA dropping into a CRT, there's no income tax owed, but that $1 million is allocated to the ordinary income tier. So what that means is the first $1 million of distributions from that trust are going to be taxed at the ordinary rate. But once we get through that, the CRT is likely invested for capital appreciation, and it's not triggering a lot of additional ordinary income. So once we get through that, it's typically 15, 20 years into that duration, the trust can start to, the CRT can distribute capital gain. And of course, that sets it apart from the IRA. We actually have some tax advantages down the road, even compared to the old stretch IRA, which of course is not possible anymore. In terms of the tax and legal authorities in the 1990s, there were several private letter rulings. You can see a couple up here on the screen that confirmed that a qualified trust like a CRT can be the beneficiary of a qualified plan. of course, we know once those assets are inside of the CRT is exempt from tax. So what we've been able to do here is restore the stretch. The CRT is preserving the pre-tax dollars in a tax-free account. The trust is growing tax-free under Section 664, and ultimately the heirs are going to get significantly more money than if they pulled the IRA assets over that 10-year window. We'll look at an example here in a bit that demonstrates just how much more. I will say though, the lens through which the decision is made here is not as numerical, I guess, as many decisions. What creates the most after-tax values for heirs? We wish that was the sole lens. Planning would be implemented a lot more. It's really not a fair comparison when we're comparing a strategy that uses the CRT, restores the stretch, and keeps everything in that tax-free environment to taking the income through or the assets through that 10-year window and getting hammered on the tax. It's not a fair comparison, but that's not the after-tax value is not the only lens that clients are looking through. For many clients who weren't going to use the old stretch IRA strategy, they're fine with the kids getting access to those assets and that income immediately, regardless of the tax consequences. So it's not going to be a fit for everyone, but where that client is tax sensitive, and we'll go through sort of the asset threshold here on the next page, it can make a lot of sense. But for some of these clients, we can model. We can point out some of the additional benefits that you're seeing up here on the screen, but it's just ultimately they're fine with the kids getting access to the assets right away, and paying the related tax. So let's be a little bit more specific in terms of where this fits and where it doesn't. So we're using a CRT here. So unlike the old stretch IRA, here we have a new entity. This is a standalone entity that does require administration. It has its own tax return. And so what that does is it puts a size threshold, if you will, on that we generally are going to want to meet. There's no hard rule in terms of what value does a CRT make sense. We'll typically say at least 500,000 in assets. In most cases, this is $1 million plus in retirement plan assets where this is being the strategy is being utilized. That said, that's not a requirement. You could set up a CRT for $100,000. Certainly no rule against that. The issue is because this requires administration, and it's making the distributions each year to the income beneficiaries. It's going to be distributing at least 5%. Then we have, even if it's a couple $1,000s a year in administration, that is difficult for the trust to keep up with. And we see a spend down on the trust assets. We deal with clients all the time who have CRTs that have decreased in value over the years to the point where they're just not feasible from an administrative standpoint. So we typically say at least 500,000 in expected assets. Of course, we're looking at this as we get older, sort of 50 or so and up. And these are generally going to be your more tax sensitive clients that in most cases we're planning on using the old stretch IRA technique. Where is this not a fit? Of course, clients who are going to use most or all of their retirement plan assets during their remaining lifetimes, there it's not going to be a fit. And then those clients that I mentioned on the prior slide, that this is just not a concern, regardless of the size of the IRA and the amount of tax that the heirs will have to pay, taking it inside of that condensed window. Some clients that's just not going to create an issue. So that's sort of where it fits, where it doesn't. Obviously, it is very case specific, as you would imagine. We'll talk about the implementation. Before we jump there, I want to make a couple important points. First is the IRA owner has to implement this during their lifetime. This is not something that can be done post-death. This, I think, in many ways is helpful just in terms of getting the client to pull the trigger on the planning. Sort of, one of the biggest obstacles to implementing any type of planning is inertia on the part of the client. So this is not something that they can wait on. If this is something that someone the client likes the concept of but wants to delay the implementation, there's a mortality risk there. If they happen to pass prematurely, it's too late. We cannot implement the planning. It has to be done during the IRA owner's lifetime. And the second point, this will bridge us into the back half of the presentation, is CRT design matters. And we'll look at some of the flexibility and design features that we can implement in these trusts to make sure that we're accomplishing the goal, which is generally, of course, we want to transfer as much wealth as possible down to their heirs with these IRA assets. So how do we implement the planning? There are three general ways we can do this. We can use a funded trust, an unfunded trust, or most commonly a testamentary trust. We'll go through these, but in each of these cases, the result is the same. The trust is named the beneficiary of the IRA. So we're going to go to the custodian of the IRA, fill out a change of beneficiary form, and name the CRT, the trustee of the CRT, as the beneficiary of the IRA. Got to do that. We can implement the planning if we don't go change the beneficiary of the IRA to the trust. It's all for naught. So that's obviously a key step here, and that's going to take place whether this is done on an irrevocable or revocable basis. In both cases, we need to make sure to change that beneficiary to the trust. So the first way we can do this is with a funded CRT. So this can be an existing CRT. We just need to have the right language in the trust agreement. Most CRTs do. What we need is a language that permits future contributions to the trust, and it will stipulate how those are dealt with on a pro rata basis in the year of the contribution. So most CRTs will have that right language, or necessary language, but the reason we don't see this a lot is even if we have an IRA owner who's interested in doing this, and they happen to have a CRT, which is not common, but if they happen to have a CRT, usually that CRT, the terms of that existing CRT are not the same as what they'll use here in this stretch RA replacement context. Namely, the CRT probably doesn't have their heirs as income beneficiaries. If it does, though, they could name that CRT as the beneficiary and accomplish this through their existing CRT. We can also use an unfunded CRT. We don't see this often because of the third option that we'll hit on, but we can create a CRT now and fund it nominally. So these are qualified trusts as far as state statutes, but under federal statutes, there's not a requirement for administration. And that makes this doable. We can't nominally fund a CRT and then over the IRA owner's remaining lifetime afford to administer that. So that's not a requirement, but the trust effective date has occurred. So the trust terms are set at that point. And that's a pretty significant drawback given that we can do this on a revocable basis through a testamentary trust or a will. And that's generally how this planning is implemented. We're still going to put the trust in place, the language in place, but it's the effective date of the trust is not until the IRA owner passes and the assets are transferred into the CRT from the IRA. And so what that means is it's flexible. The IRA owner can make changes to the CRT terms throughout their remaining lifetime. Let's say grandchildren are born, or kids get married, and we want to include a son-in-law or daughter-in-law. We can accomplish those changes, which we couldn't do if we use the unfunded CRT. Maybe the IRA owner wants to undo the planning. Again, that's possible as well. As long as we're doing this through a testamentary trust. Everything is revocable up until the point that the IRA owner passes away. So we can see now, no matter what here, we end up with the CRT, but most often we're going to be using that third option. Once we've decided, okay, the client wants to implement this planning, now we can talk about the CRT design. When it comes to CRT design, when we're looking at it here at CRT Experts, we look at CRT design through the lens of the taxpayer, the non-charitable beneficiary. We want to maximize the value to the income beneficiary, and we want to give them the maximum flexibility that's available under Section 664 of the Internal Revenue Code. As obvious as that might sound, it's rarely done in our view. Most CRTs out there, if the clients were made aware of some of this flexibility, we'll talk about some of it here today, they would have designed that CRT a little bit differently. The two top bullets you see there on the screen, duration, meaning adding successor income beneficiaries using what we call a lives plus term CRT to stretch that CRT and include as many family members as possible, and deferral, giving the income beneficiaries the ability to defer income. Those are two techniques we'll look at today that are highly underutilized, at least in our experience, and we'll talk about those, and we'll use this comparison that we'll set up on the next slide to look at some of those features. Beyond that, though, even basic flexibility with respect to trusteeship, the charitable beneficiary, we want to make sure that any flexibility that the IRA owner wants to infuse in that new CRT is implemented. I will say, so there is a difference here. So if we go back to that traditional CRT, client owns appreciated property, they want to defer the capital gain, contribute the property to the CRT, that pays them a lifetime income stream. That is a self-settled trust. The donor is the income beneficiary. So if I'm setting up a CRT for myself, that's going to pay me and probably my spouse an income stream, no brainer. I'm going to want to give me as much flexibility as you can. I want to maximize the value to me. And this is different with a stretch replacement CRT. By definition, our donor is deceased. So the income beneficiaries are in some cases spouses and children and grandchildren. So particularly when it comes to the children and grandchildren, the IRA owner may not want to give them all of the flexibility that he or she may have given themselves. The two key areas there are trusteeship. In most cases, the income beneficiary is the trustee. That's as long as you've got an administration firm to handle the tax reporting for the CRT, that's what we would usually recommend. But here, where the donor is not the income beneficiary, they may not like the idea of Junior sitting as the trustee. If Junior is what we would call a creative spender, we have some concern about if Junior is sitting as trustee, Junior may invest the trust assets too aggressively, chasing yield or something like that. We may want to use a corporate trustee as the trustee, or we may want to have one of our advisors sit as the trustee. The second is the charitable beneficiary. In many cases, it's a family donor advised fund as the ultimate remainder beneficiary here. Whoever it is, the alma mater of the donor, whoever that charitable beneficiary is the donor, the IRA owner, okay, giving their kids and or grandkids the power to change that. Some are, some aren't. So that is a difference here. And when we compare it or contrast it with that traditional creation where the donor is going to be the income beneficiary, and definitely something to keep in mind. We're going to talk about, as we go through this example, lives plus term CRTs, maximizing duration, and structuring CRTs for deferral. We will hit on it topically. If you're interested in a deeper dive on either of those, you can see the webinar up on the screen. That will give you that deeper dive on these design features. Okay, so we're going to set up an example here, and we're going to use this CRT for family B here to look at a couple of these design features. So in our example here, we have family A, who's going to take the IRA assets during the 10-year window, and we have family B, who's going to use a CRT to replace the stretch. Everything else is equal, is the same. We have $1 million, we'll use $1 million IRA and anticipated funding for the CRT. So first, let's look at how we're going to structure this CRT. So in our family A, we're going to put the spouse on as the initial income beneficiary. Sometimes we do that, sometimes we don't. We'll talk later about when it comes to deferral, why it's often structured this way. And then we have 2 children and 4 grandchildren. So the 2 children are the successor lifetime income beneficiaries. So when the spouse passes away, the 2 children will step in as lifetime income beneficiaries. When one passes, the survivor will receive all of the income. At the survivor of the 2 children's death, now our grandchildren, our 4 grandchildren, are the income beneficiaries for the shorter of their lifetimes and a fixed term of years. And so this is called lives plus term CRTs. We'll hit on that here in a moment. But this is a 3-generation CRT that we're using here. One thing to note, we're asked a lot, what if we have 3 or 4 kids? We'll talk about, many of you are, I'm sure, are familiar with the 10% test, but if we have 3 or 4 kids, or if we have more family members that we want to include, we can't do that with a single CRT. No problem. We can use multiple CRTs. This is a different family. This is from the other webinar that I had up on a couple slides ago. The Jones family, where they had 3 kids, they also wanted to include their son and daughter-in-laws here. So we couldn't have done this. We couldn't put all of these family members on a single CRT, but we can fund 3 different CRTs in this case, fund them equally, and accomplish the planning goals in terms of who they wanted to include as the income beneficiaries. Here again, we are using what's called a lives plus term CRT. The same here. We have 3 lifetime income beneficiaries, the spouse and the 2 children, and then we have 4 term beneficiaries. So let's talk about this structure. As I mentioned earlier, we think that this structure and deferral structure in a CRT deferral are underutilized in terms of just where they're implemented out there with new CRTs. This one, though, is just in terms of the lack of awareness, even with sophisticated practitioners, the awareness that we can structure a CRT in this way. So generally speaking, when it comes to duration, the goal is we want that CRT to last as long as possible, and we want to include as many family members as possible. What we're up against when we're in accomplishing this is what's called the 10% remainder test. I'm sure many of you are familiar. This is a test that is relevant at CRT inception. And what it is that the IRS will value both interests in the trust based on the IRS's own interest rate, what's called the Section 7520 rate, their own life expectancy tables, and the CRT payout rate. The IRS is going to assign a value to what it thinks will pay to the income beneficiaries, and then what will eventually go to charity on a present value basis. What is projected to go to charity has to be 10% of the initial value of that CRT. And so what that means is, in family B here, we could not structure that CRT with those grandchildren as lifetime income beneficiaries. They're too young. The trust would fail the 10% remainder test. That test is only applicable at inception, when we are determining who the income beneficiaries are and the payout rate of the CRT. It doesn't mean that 10% has to go to charity eventually. It just means that upfront at inception, at least 10% of the assets that go into the trust need to be projected to go to charity per the IRS formula. And so this is where a lot of generally speaking, it's what we hear a lot is, well, you could set up a CRT for lifetimes or joint lives, or you can do it for a term of years. You can't do both. That is not correct. So we can set up a CRT so that it is the distributions go to one set of individuals for their lifetimes, and then another set of individuals for the shorter of their lifetimes or a term of years, maximum of 20. So technically, even though this is typically referred to as life plus term or life plus term CRTs, because that in our case, the third set of income beneficiaries, the grandkids, whoever the term beneficiaries are actuarially going to significantly outlive that term. So in effect, these are almost always, unless there's significantly premature deaths by those term beneficiaries, these play out in practice as lives plus term. But technically, this is lives plus the shorter of additional lives and a fixed term of years. So you can see the regulations, where it's the relevant summary of 664, where this is permissible. But in a nutshell, the regs require that a CRT term may not extend beyond either the life or lives of a named individual or individuals, or a term of no more than 20 years. So a CRT can be structured to pay for the lives of certain named individuals, followed by payments to other individuals for the shorter of a term of years not to exceed 20, and the life of those other individuals. The trust cannot last beyond the lives in being at the date the CRT is created, and we are not running afoul of that requirement. So that's what we're using in this case to extend this income stream to that third generation, all the way out to the grandchildren. So when believe it or not, so I mentioned many even sophisticated practitioners are not aware of this structure. There's estate planning software out there that won't even calculate it. So fortunately there's a lot out there that will. We use two versions here at CRT Experts, Crescendo Interactive and Easy Charitable. What you see up here on the screen is the output from Easy Charitable. What I want to do is show for a family B here exactly where this 10% remainder test and how we determine what that maximum term is for those grandkids. So with Easy Charitable, one of the things, many of you are probably familiar with Lee Hoffman. This is his software. One of the things I like about Easy Charitable is it will allow us to maximize that successor term to the day if we wanted. In this case, we're doing it to the month. But we can maximize that and stretch that duration as far as we can to the absolute longest period possible before failing the 10% test. So you can see here, we're just barely passing the test here at we're at 10.03%. And so you can see our inputs. We have our spouse who's 84 years old, 59 and 56-year-old children. Those three are lifetime beneficiaries. And then we have our four grandkids as the successor term beneficiaries. And you can see here, given a 5% payout rate for the trust, most of the time we're going to be using that 5% payout rate because that's going to allow us to stretch this as far as we can. We can go for the lifetimes of those three individuals plus a 17-year and 10-month term. So this is the software calculation that is done at CRT inception. These are projections based on how everyone's age at the IRA owner's life expectancy. The way this will play out, though, once the IRA owner passes, the trust is effective, the calculation is run at that time. That's when we would determine the maximum term following the death of the last of the spouse and the two children to pass. So now let's look at where the rubber meets the road here and look at our comparison of the two families, of the two strategies. I would typically go graph by graph, but I want to keep us on schedule. So we'll just look at the overlay here. So what you're looking at is the two families. We're comparing, use a CRT to withdraw from the IRA. The solid green line is the value of the CRT account. So that's the investment account. It's distributing 5% each year. And each annual distribution is the vertical green line that you can see. That's the CRT distribution for that year. The solid red line is the IRA. So that's distributing all its assets over the 10-year period. The dotted red line shows the value of the money withdrawn from the IRA after taxes and spending that is reinvested. So to keep it apples to apples, the heirs are spending the exact same amount in each year in each scenario. So we are withdrawing from that reinvested IRA account the exact same amount that the heirs receive from the CRT. And that's the vertical red lines, those what they withdraw there from the reinvested IRA account. And as you can see, eventually under withdraw from IRA scenario, the money is all gone. But the income from the CRT continues to grow. Ultimately, we're getting more than double the amount of income using the CRT to replace the stretch. As I mentioned earlier, this is just not a fair comparison. That immediate tax hit on the IRA is just too much for that strategy to overcome when it's put up against a CRT that's maintaining the IRA assets in a tax-free environment. So as we can see here, why do we see this little jump here? So remember when we talked earlier, when the IRA assets are transferred to the CRT, that value sits in the ordinary income tier. So in $1 million, the first $1 million of going into the CRT, the first $1 million of the distributions are going to be taxed as ordinary income. What we see here is when we finally get through that ordinary income tier and we can start to distribute capital gain. And so what you can see here is that little jump is we're looking at the after-tax value, and that's going to jump because we're paying a lower effective tax rate once we're able to distribute from the CRT at the capital gains rate. So the second design component I want to talk about, and then I want to look at how this would work for family B, is deferral. And this will apply whether we're looking at this in the stretch IRA replacement context or just a traditional CRT creation. We need to, if the desire to defer distributions from the CRT is anticipated, we need to work that flexibility into the CRT design. And the way that we're going to do that is to use a type of CRT called a net income with makeup CRT, often called a NIM CRT. I'm sure many of you are familiar with NIM CRTs. So a NIM CRT, unlike a standard CRT, if we have a 5% standard CRT, that's going to distribute that 5% every year, whether the trust makes money or loses money, whether the income beneficiary wants the income or not. It has to pay out that 5%. A NIM CRT, on the other hand, will distribute the lesser of the stated payout rate, 5% here, and trust accounting income. So there is a net income limitation. The trust is never required to pay a beneficiary more than its income. So if it doesn't have income, nothing has to be distributed. And there's a makeup provision or catch-up provision that enables us to pay any unpaid or deferred amounts in future years. So taken together, the income exception and that makeup provision can be used to control or regulate the timing of distributions from the NIM CRT to the income beneficiary. So this is, if you want a deeper dive, you saw that the link for that webinar earlier. We drill on this particular technique, but at a high level here, this is all centered around trust accounting income. So trust income is a cash concept, and what that means is the trust will not have income if it does not have a cash receipt. And there's several techniques out there to control the timing of trust receipts, and thus when a NIMCRUT will have trust accounting income, but they all work the same way. So the investments are held in what's often referred to as a container. That container, it can be a variable annuity, it could be a partnership. Most often, it's a single member LLC of which the NIMCRUT is the sole owner. There's administrative and tax advantages to going that route, so that's typically what we'll see. But regardless of what type of container we're using, the idea is that until we distribute cash from that container to the NIMCRUT, we don't have a trust accounting income. So if the interest, dividends, realized capital gains that would need to be distributed, if the NIMCRUT own the assets directly, those are still incurred, but the trust accounting income isn't triggered until we have a cash distribution from the container to the NIMCRUT. So that allows us, the CRT's tax return, the 5227, is still tracking that income. It's allocated to the undistributed income to those tiers. But until we have a cash distribution from the LLC or the annuity to the NIMCRUT, we do not have trust accounting income. So that's at a high level. There are certainly obviously technical details that we need to be mindful of and addressed. Those are outside the scope of this discussion, but you can check out that webinar if you want to see that discussion. So now let's look at deferral in light of Family B here. So in many cases, when in the stretch replacement, it is given the nature of these clients, in many cases, most at least that we see, it's not anticipated that spouse will want or need any income. Why would we put the spouse on the CRT then? Because we can use that spouse's remaining lifetime to put the trust into deferral. We could put an upfront deferral period on the CRT, and that is going to increase what's distributed later on to the kids. Let's look at Family B here to see the extent that would increase the income. So what we're doing here, same structure, same CRT, we're just structuring it so that spouse can defer income. And let's assume that the spouse defers income. She gets a 10-year life expectancy. So let's look at the same overlay, except we're going to put a 10-year upfront deferral period on the CRT assets. So what that's doing is it's delaying distributions for 10 years. So it's allowing those trust assets to compound more rapidly. Not only are they growing tax-free, they're not making any distributions. I describe it a lot. It's like a runway for takeoff. That early deferral just boosts long-term value, what's eventually distributed to, in our case here, the kids and grandkids. As you can see, no change to Family A, but with Family B, our income has gone to the heirs has gone from $3,586,000 when there was the spouse was taking distributions. If the spouse defers those distributions, we're up to $5,218,000. So that's significantly more income that we're able to generate for the heirs using that upfront deferral period. Obviously here, the spouse needs to outlive the IRA owner. In some cases, there's a desire just to get the income to the kids right away. That's fine. We're creating this CRT. It's a blank slate. We're going to design it however the IRA owner wants it designed. As you can see here, our that point where we get through that ordinary is pushed out a little bit to looks like about year 20, since we put that upfront deferral period on there. So just before we wrap up, just wanted to point out, go back to using multiple CRTs because there's a couple additional reasons. We just saw one, or at least we're getting to one of those reasons. We talked about deferral. In some cases, it's anticipated that one of the heirs will want to defer income. So we can't. It's possible but difficult to do that inside of one CRT. We need a discretionary CRT. Most of the time, if it's anticipated that one of the kids would want to defer income, the other will want the distributions, we will use two CRTs. Again, if we're keeping the administration under one roof, this should not be more expensive or complicated. We just need multiple CRTs to accomplish the planning. That would give both children, but if one child wants to defer the income, they have the ability to do that. They are taking more mortality risk here. So this is another reason to use multiple CRTs. If we use two CRTs and it's just the spouse as the initial income beneficiary and then each child as a successor, we have more mortality risk than the old using one CRT with both kids. So what we can do here is we can, and if the IRA owner is okay going outside of that bloodline, we can use the child's spouse. What that will do is it will reduce that mortality risk. And if it's anticipated that one child would want to defer, that is going to create significantly more money or income for those grandchildren down the line. So a lot of different ways we can take the design in terms of not only the design of the CRT itself, but how many CRTs we're using to accomplish the objectives. Okay, so to wrap up here, we've talked about using a CRT to restore the stretch. We've talked about when that is done. It has to be done during the IRA owner's lifetime. We've talked about how it's done. There's 3 ways to do that. We can use an existing CRT, an unfunded CRT, or what's most commonly utilized is doing it on a revocable basis through a revocable trust or will. We looked at, once the decision has been made to implement the planning, the different ways we can design that CRT and the considerations, namely between, or as far as who do we want to include as income beneficiaries, and do we want to build in the ability for the income beneficiaries or the trustee to regulate that income stream. All CRTs are not created equal. We need to make sure that we implement all the flexibility that the IRA owner wants implemented. So hopefully this has been helpful and informative for everyone. My contact information is up here on the screen. Please don't hesitate to reach out. If you have any clients that are interested in looking at illustrations of the planning that we've talked about today to replace the stretch, but just any CRT question, like I said, we want to be your first call, whether there's a potential engagement for us or not. We are always happy to kick around CRT ideas or questions, no matter how esoteric they might seem. As I always say, we'll nerd out on CRTs anytime. So genuinely welcome your inquiries, whether by phone or email. Don't hesitate to reach out. Hopefully this has been educational for everyone. I hope everyone has a great rest of the day, rest of the week, and hopefully we'll hear from you sometime soon. Thanks again.